There's a moment in every monetary collapse when the central bank realizes its power was always an illusion. The Federal Reserve is approaching that moment right now. And for the first time in its 111-year history, unlimited money printing won't be enough to prevent what's coming. On the surface, the Fed appears omnipotent. They can create trillions of dollars with keystrokes. They can buy any asset, bail out any institution, flood any market with liquidity. They've done it before. In 2008, they prevented total collapse. In 2020, they turned a pandemic crash into a stock market boom. They are the masters of the financial universe. But that's exactly what makes this moment so dangerous. The Fed's apparent omnipotence has masked a fundamental shift in the mechanics of monetary control. Something has changed beneath the surface. Something that renders their traditional tools not just ineffective, but counterproductive. To understand what's happening, look at Germany, 1923. The Reichsbank had unlimited power to print marks. They used it aggressively, believing they could print their way out of crisis. The more they printed, the worse things became. By November 1923, it took 4.2 trillion marks to buy a single dollar. Unlimited printing power had become unlimited destruction. The Reichsbank made a fatal assumption. They assumed that printing money would create demand for money. They were wrong. Printing money destroyed confidence in money. Once confidence breaks, printing more only accelerates the collapse. But Germany wasn't the only central bank to learn this lesson. In the 1970s, the Fed faced a similar trap. Inflation spiraled out of control. The dollar lost value against everything real. Foreign governments converted dollars to gold so rapidly that Nixon closed the gold window entirely. The Fed printed more money to stimulate growth. The result was stagflation, a decade of economic stagnation with persistent inflation that theory said was impossible. The Fed escaped only by allowing rates to reach 20%. Chairman Paul Volcker induced the worst recession since the 1930s to break inflation. It worked because the dollar was still the undisputed global reserve currency. Foreign nations had no choice but to accept American monetary policy. That global captive audience no longer exists. Now look at today. The Federal Reserve has printed more money in the past 4 years than in the previous century combined. The M2 money supply exploded by over 40% during the pandemic response. Every dollar they created diluted the value of every dollar already in existence. But unlike 1923 Germany, the world still accepted those dollars. The global reserve currency status protected the U.S. from immediate hyperinflation. That protection is ending. For the first time since World War II, major economies are actively moving away from dollar-denominated trade. China and Russia now conduct most of their bilateral trade in yuan and rubles. Saudi Arabia is accepting yuan for oil payments. The BRICS nations are developing alternative payment systems that bypass the dollar entirely. Each time a transaction happens outside the dollar system, America loses a piece of its monetary sovereignty. This creates the velocity trap. When overseas dollars come home, they chase the same goods domestic dollars are already chasing. The result isn't just inflation, it's accelerating inflation that compounds on itself. The Fed understands this dynamic. That's why they've been raising interest rates at the fastest pace in 40 years, trying to strengthen the dollar and slow inflation. But here's the trap they've walked into. Higher interest rates make the national debt unsustainable. Interest payments on the debt now consume nearly 15% of all federal spending. By 2026, those payments will exceed defense spending, Medicare, or any other major government program. The mathematics are unforgiving. The government needs to either cut spending dramatically, raise taxes dramatically, or print money dramatically. Cutting spending triggers recession. Raising taxes triggers political upheaval. Printing money triggers currency collapse. There is no fourth option. Every choice the Fed makes now creates a larger problem somewhere else in the system. If they cut rates to help the economy, inflation accelerates, and foreign confidence in the dollar erodes faster. If they raise rates to fight inflation, debt service costs explode and banks fail. If they hold rates steady, both problems compound simultaneously. This is what makes 2026 different from every previous crisis. In 2008, the Fed could lower rates to zero and print money because inflation was low and foreign demand for dollars was high. In 2020, they could do the same because the pandemic created global demand for safe assets. Today, inflation is persistent and foreign demand for dollars is weakening. The old playbook doesn't work when the fundamentals have shifted. The warning signs are already visible. Treasury auctions are struggling to find buyers. When the Treasury Department auctions new bonds, they're having to offer higher and higher yields to attract sufficient demand. In several recent auctions, primary dealers had to step in and purchase bonds that foreign buyers rejected. This is unprecedented in modern American financial history. Foreign central banks have been net sellers of U.S. Treasury bonds for months. China alone has reduced its Treasury holdings by over $100 billion in the past year. Japan, the second largest foreign holder of U.S. debt, has been forced to sell treasuries to defend its own currency. Even traditional allies are diversifying away from dollar assets. Regional banks are sitting on hundreds of billions in unrealized losses from bonds they purchased when rates were near zero. These aren't theoretical losses. When depositors withdraw money, banks have to sell these underwater bonds at massive losses. Silicon Valley Bank collapsed in exactly this manner. First Republic followed. More than 600 regional banks are in similar positions, holding long-term bonds worth far less than their face value. Commercial real estate values are collapsing as higher rates make refinancing impossible. Office buildings purchased with cheap debt are becoming stranded assets. The banks that financed these purchases are facing loan losses that could dwarf the savings and loan crisis of the 1980s. Unlike residential mortgages, commercial real estate loans can't be packaged and sold to government agencies. The losses stay on bank balance sheets. Each of these problems would be manageable in isolation. Together, they create what systems theorists call cascade failure. When one element breaks, it triggers failures in connected elements. Those failures trigger more failures. The interconnections that make the system efficient during normal times become transmission mechanisms for crisis. Consider the chain reaction. Treasury auctions fail, yields spike. Higher yields devalue existing bonds, forcing bank losses. Bank losses reduce lending, slowing growth. Slower growth cuts tax revenues, forcing more borrowing. More borrowing means harder to finance auctions. Each cycle reinforces the next. The derivatives market amplifies these cascades exponentially. Banks, hedge funds, and pension funds have constructed a web of interest rate swaps, credit default swaps, and currency derivatives with a notional value exceeding $600 trillion. These instruments were designed to hedge risk, but they concentrated instead. When interest rates move unexpectedly, counterparties face margin calls that force asset sales. Those sales create more price volatility, triggering more margin calls. The Federal Reserve's traditional response to cascade failure is liquidity injection. They become the buyer of last resort, purchasing whatever assets the market won't touch. But liquidity injection only works when the underlying problem is temporary illiquidity. When the problem is permanent insolvency, liquidity becomes debt, and debt becomes inflation, and inflation becomes currency collapse. The Fed's tools for stopping cascade failures all require printing money. But printing money is what created the cascade in the first place. The Federal Reserve has spent over a century building its reputation as the lender of last resort. That reputation is based on a simple premise. They can always create enough money to solve any liquidity crisis. But liquidity crises and confidence crises are different animals. You can't print confidence, you can only preserve it. And confidence, once lost, is nearly impossible to restore. History shows that when a reserve currency begins to lose its status, the process accelerates rapidly. The British pound dominated global trade for over a century. When confidence began to crack after World War II, sterling went from universal acceptance to secondary status in less than 2 decades. The transition wasn't gradual. It happened in waves, each crisis weaker than the last, until the final break became inevitable. The dollar is entering the same transition. Not next week, not next month, but within the timeline where these monetary mechanics play out. The Fed's unlimited printing power won't stop this transition. It will accelerate it. Every dollar they create to solve today's crisis becomes tomorrow's inflation, tomorrow's loss of confidence, tomorrow's reason for the world to seek alternatives. What happens when the world's central bank loses the ability to control the world's reserve currency? History doesn't provide examples because it's never happened before. The Federal Reserve isn't just the central bank of America. It's the central bank of the global financial system. When that system breaks, there's no higher authority to provide a bailout. The implications extend far beyond financial markets. American military power depends on the ability to finance operations with printed dollars. Social Security, Medicare, and every other government promise depends on the world's willingness to accept those dollars as payment. The American standard of living depends on the ability to exchange paper for real goods produced by foreign workers. When reserve currency status ends, these arrangements end with it. The country that issues the reserve currency can consume more than it produces, import more than it exports, spend more than it earns. Every other country must live within its means. America is about to join every other country. The adjustment will not be gradual. When currency crises begin, they accelerate rapidly because they feed on themselves. Fear of devaluation causes people to dump the currency, which causes devaluation, which causes more fear. The process continues until the currency finds a new equilibrium at a dramatically lower level, or until it loses all value entirely. The real reason the Fed can't save us this time isn't that they lack tools. It's that their most powerful tool has become their greatest weakness. Unlimited money printing worked when the world had unlimited faith in American money. That faith is finite, and it's running out faster than they can print dollars to replace it. The machine that saved us in 2008 and 2020 is the same machine that's destroying us in 2026. The Fed knows this. They can see the same numbers, the same trends, the same mathematical impossibilities that anyone can see if they're willing to look. But acknowledging the limits of their power would trigger the very confidence crisis they're trying to prevent. So they maintain the illusion. They speak in measured tones about soft landings and transitory pressures. They adjust interest rates by quarter points and issue carefully worded statements about data dependency. They perform the rituals of monetary control while the foundations of monetary authority crumble beneath their feet. The most dangerous phrase in monetary history is "trust us." When central banks start saying it, it means trust is already gone. The Federal Reserve hasn't said those words yet, but their actions speak louder than their words. And their actions reveal an institution that knows its power is ending, but can't admit it without hastening the end. History doesn't collapse loudly. It collapses quietly, then all at once. The Federal Reserve's quiet collapse has already begun.